All right. Well, some more people might be trickling in here in a little bit, but we're going to get started anyways. So I want to thank everybody for joining and just want to caution you guys. I am just north of Boston and they have issued a tornado warning. So if you see me start flying around the room, fear not, I'll be back. And the power is flickering. So hopefully I'll be good. All right, so today we're here to discuss using direct indexing to reduce tax exposure to build a diversified portfolio. Now, my name is Brian Kirby. I'm the lead on the advisory team here at Alfonso Wealth. I have over 20 years experience in advisory. I began my career as a retail advisor at Merrill Lynch. I did that for a number of years before I moved to the institutional side, where I worked on mega corporate plans. I also worked on large government 457 plans, 403B nonprofit planning, non-qualified deferred comp planning, executive liability, and executive benefits. So just to kind of give you an idea of what we do at Alfonso, we provide a comprehensive wealth management solution, direct indexing, and tax mitigation strategies. And we do that with a flat fee approach, more akin to a family office model. And we are also a registered investment advisor. So I'm not sure who was with us on our last webinar, but I was in charge of the slides on that one. And I promise I am not in charge of the slides today, so this should go a lot smoother. So our goal today is going to be to share some insights that have worked specifically with our clients and answer any questions at the end of the presentation. You'll notice there's going to be a Q&A box. Put your questions in there at the end of the presentation. I promise I'll get to all those questions. So we're going to try and keep this practical, and we're going to focus on real-world applications. So joining us as today's speaker is Rupesh Goyal. Rupesh has over 10 years experience in portfolio and hedge fund management, where he managed assets in excess of 300 million, consistently beating benchmarks. He has an MBA degree from the Carroll School at Boston College and is an active member of the CFA Boston community. So let's keep this interactive. Remember the Q&A button at the bottom, and we'll cover all that at the end. All right, Rupesh, over to you.
Thanks, Brian. So let's talk about direct indexing. So it's a term that gets thrown a lot around in the wealth management space. And it's one of those things when the moment you understand what it actually does, you immediately think, why doesn't everyone do it? So that's the goal today. By the time we are done, we are going to have a clear answer to that particular question. So here's the roadmap. What we'll be covering today is what direct indexing actually is and compare it side by side with a standard index fund, walk you through exactly how it trims your tax bill and talks about who is it right fit for. And then we'll end up how it actually works day to day and how much you can expect to save it from this particular strategy. So let's get started. So what is direct indexing? Imagine you go and buy S&P 500 index. What you are actually buying here is you are buying just one thing, which is one fund that gives you a slice of all the 500 companies that are there in S&P 500. Super clean, super simple. What direct indexing does, instead of buying that 500 stocks wrapped around in one wrapper, you buy those 500 companies individually. So what are we doing? Same market exposure, same diversification, same return potential, but instead of one ticker here, we are actually owning 500 roughly tickers sitting right inside your brokerage account. Now, at this point, you might be thinking, okay, but why does it matter? Who cares if we own just the one fund or the 500 companies? That is exactly we're going to talk about in the next particular slide. So if you can see, here is a side-by-side comparison between the two. So if you look at the first row, which is the market exposure, both gives you a same level of returns in terms of how much market is going to provide you. But now look at what you gain. You can do tax loss harvesting at an individual stock level versus in index fund, most thing, because you are kind of purchasing a wrapper, which is all the 500 companies in one kind of a block, not individual. Also, you get automated management inside direct indexing. The only thing that changes when you compare direct indexing with index fund is the cost. And as we will see it in a minute, that this cost actually justifies more than what it kind of entails and ultimately pays up for the cost that you're going to kind of end up paying for it. So in short, same investments, just with more levers to kind of pull than compared to index fund when it comes to direct index. So let's see how it shrinks your actual tax bill. This is where it gets really, really interesting. This is the part that will most probably makes you lean forward. And if it's not, maybe you are not in the right place. So here's the thing. That's always true. Even in a great market year, some stocks in your portfolio would be down, which is just part of the normal volatility. Some companies, let's say, had a rough quarters. Some companies lagged their particular sectors, or there was some bad news, which was temporary that affected that particular stock. Now, with an index fund, you can't do anything about that particular incident or that particular instance because you owe just one thing. And once it goes overall up, you are fine. You are kind of gaining. You are not looking at any individual losers inside that particular wrapper. But with direct indexing, you actually can and take the benefit out of it. Let's say you had Tesla and Tesla had a rough quarter. The stock was down 15% for that particular period. How you can take the benefit out of it? You just sell it, you book the loss, the IRS sees this loss, and you can use it to offset your gains elsewhere, either it be it your income to a certain level or through any other capital gains which you might have incurred throughout the years. So as you can see here, on a 100K portfolio, we are looking at roughly $7,000 of harvested loss over a particular year. And that's very much like an industry standard and an industry average. Now, if you scale up to, let's say, 500K or let's say even 1 million, you're looking at real tangible benefits. And that too over a period of years, because again, it's a compounding effect. As you keep on accumulating these losses and keep on offsetting your income and your other capital gains, you are also kind of gaining out of those investments when you're kind of putting that inside markets or any other fixed income related instruments. So now let's talk about when it's actually worth doing, which is a very important question. And I will be very straightforward with you. This isn't for everyone. It's only for a specific set of folks who are kind of in the categories which are on the left side. So as you can see on the left side, you can see the people who get most out of this direct indexing is one, if you have 250K or more in your taxable account, because that makes it more tangible in terms of the benefits that we are looking at. Second, when you have a higher tax bracket, let's say your federal and state tax bracket is over 32% for short-term capital gains, and for long-term, it's roughly 20%. That's something that we are looking at. If those are the brackets you are in, that's a good thing for you. Third, you are sitting on a capital gains or you are about to incur a lot of capital gains, which obviously you can offset using these tax loss harvesting related techniques. Fourth, if you got huge amount of concentration in your employer stock and you are again sitting on the capital gains there and you are looking to diversify. Again, very powerful instrument there because it can help you diversify as well as reduce or eliminate the tax liabilities associated with those sellings. And then on the right side, you can see if, let's say, most of your money is in a 401k or IRA, or the tax benefits doesn't apply in the same way as it would in case of your taxable account. And also if you are, let's say, in a lower tax bracket, the math simply gets thinner and it probably isn't worth it for you to kind of do something like that. In that case, it makes sense for you to kind of just go for a simple approach, which is index investing. So let's talk about a very special customized technique which you can use within the direct indexing. We have talked about how it reduces your tax bill. Now there is another special aspect of it which is very, very interesting and which is actually one of my favorite parts. Why? Because most of people don't even know about something like this exists. Now, let's say if you are working in a large public company, let's say Apple, Amazon, Microsoft, you already have a very, very deep exposure to that particular stock in terms of your RSUs, in terms of your ESPP, and in fact, your paycheck also, because you're working there and you're getting your paycheck out of it, those as well. So you are heavily devoted and heavily concentrated in that particular aspect. And then now you go by and purchase S&P 500, which already have, let's say, if you are in Apple or Amazon, you already have 5% of that shares in addition to what you already owe in RSUs and ESPP. So that's where direct indexing become even more powerful. With customizations, you can remove your company stock out so that when you are kind of investing, you are not just diversifying, but you are also making sure you are not further adding your stock position in your employer, because that would again means over concentration inside your particular employer stock. So this exclude ticker kind of thing can be done in a very specific places, like let's say working with your advisor or in a very specialized kind of direct indexing approach, but it gives you a very, very good way to kind of reduce your exposure to your particular employer. So now let's talk about the timing. So how it works in a day-to-day basis and how you can kind of manage it. Two quick things here. So in terms of when to kind of start for something like this, and then obviously how it kind of works. So on the timing, the earlier you start, the better it is, as it gives your portfolio more time to harvest losses. Markets can have up and down, and we all know that markets are like volatile. They always see these ups and downs. There is never kind of a one way trajectory there. So the more time you give, the more time you kind of actually use to kind of harvest your losses. The second is, which usually kind of surprises a lot of people, is the day-to-day experience that is associated with direct indexing. So with direct indexing, you actually don't need to kind of feel it. Most of the platforms that you work with will be tracking your holdings on a daily basis. When the harvesting loss opportunity arise, they execute automatically. They track the wash sale rule, which makes sure that you never kind of accidentally end up violating them and kind of increase your tax liability by accident. And at the end of the year, you get a complete clean report that you can pass it on to your tax consultant or your CPA for your tax filings. You're not getting alert every time a stock gets swapped, which could be a lot, especially considering these days where there is volatility is too much. You're not approving any individual stocks. It's running in the background, working for you while you focus on everything else in your life. So let's take a now real example of how it kind of looks in terms of the numbers. So let's say you start with a 500K portfolio in your taxable account, where significant portion of your employer stock is already there, which is through RSUs and ESPP. So this is when you kind of start year one. So you set up a direct indexing account. What you do here is you exclude your employer stock, and the platform, what it does is harvest the losses, which is roughly $50,000 in the year one. So now these losses can be used to offset gains from your prior vests, which you kind of incurred 4 years ago and which have a significant capital gains. So the tax savings we are talking about in just the year one is $15,000. Now let's compound it to over 5 years. And now we are looking at more than 100K of cumulative just tax savings. We're not talking about appreciations in a portfolio, just the tax savings here. That stays in your account instead of this being passed on to the IRS On top of that, you get to diversify your employer stock without any tax implications. And remember, the market exposure here didn't change here. When you were investing in ETF, it still remains the same. The returns potentials also remain the same. The only thing that changed was the tax implications associated with this particular account. So now let's talk about how do you actually set this up. There are few parts around it. There are certain robo-advisors like Betterment, Wealthfront, which offer light-weighted version of it, kind of a very simplified version. And there are some firms like Frick, they can kind of provide some kind of customizations around it as well. Uh, the best way is to kind of work with a financial advisor who can set these things up at a major specialized firms like Charles Schwab or your Fidelities. What is the best part of this approach is that it generally is much more cost effective than if you're going directly. And then you can have more customizations around these particular indexes based on your requirements and based on your preferences. All you need to do here is sit down with your advisor and model the potential tax savings that are based on your specific financial situation. What this will do is this will help you determine whether the benefits justify moving forward, and if the numbers make sense, create the strategy that can be implemented and can be tailored to your individual goals, your income, and your tax profile. Okay, so that's the core of it. Let me stop talking and let's get into the question and answer section. Brian, the floor is yours to kind of take it forward.
Great. Thanks again, Rupesh. Now, I know this is a lot to digest in one sitting, especially if you're trying to balance a full-time role and manage a strategy like this. So to make this useful for you, we put together a full slide deck from today and a recap video. So if you want to revisit a specific strategy, we're going to email that out to everyone. Now, typically, advisors charge a percentage AUM to manage a direct indexing portfolio. Our approach is a little different. So regardless of your portfolio value, 50,000, 50 million, we run a flat fee subscription-based cost. So the cost is the cost is the cost. Okay. Now, there is no one-size-fits-all solution. Requires in-depth planning, and it's going to be based on each individual. So let's get to some questions that have already popped up here. First question, Rupesh, is I have no gains. Do the losses just sit there, and for how long?
Yeah, I mean, if there are no gains, generally, yes, the losses will sit there. There is no limit in terms of when you kind of stop not using those losses that you have incurred. So you can use it, let's say, even after 10 years from now, you had any capital gain, you can offset it to use it. So yes, this is still very, very useful in terms of accumulating losses until that particular time comes where you know that, okay, the gains are coming any moment and we'll be using that to harvest those kind of gains with these losses.
Okay, so most of my money is in my 401k and Roth. Does this not help me at all?
Yes, in that case, probably not, because those are very tax-friendly accounts and those are not taxed on a day-to-day basis. So in that case, it wouldn't make sense for you to kind of go for direct indexing. You need to have, let's say, at least 200 to 250K in your taxable accounts, which are not 401Ks and Roth, to get the maximum out of this particular strategy.
Okay, are these considered short-term or long-term losses?
It's mostly short because the benefit of the short is it can use to kind of offset your short-term gains as well as long-term gains. So most of the times it's short, but in certain instances we have seen there are some long-term losses associated with this particular strategy as well.
Okay, how long can we defer losses? If I never sell, do I never need to pay those deferred taxes?
Absolutely, yes. So how it works is, so you keep on deferring those gains that were associated through this direct indexing. And let's say if you were to kind of in the end pass on this investment account to your children, once you kind of pass those cost basis reset and you end up never paying taxes on those.
Great. Okay, so next question is I have a few ETFs with large overall gains. If I go for direct indexing, do I fund that account with cash or in kind, the ETF? Does it immediately sell the ETFs to create cash, but then generate large cap, but then doesn't that generate large capital gains?
Yeah, it's not ideal if let's say you already have the ETFs and then you're looking to sell those for direct indexing because you are just replacing one with another. And technically you are kind of paying capital gains to kind of take that capital losses. So in that case, it doesn't make sense. The only couple of scenarios where it makes sense is one, if you're funding it with cash, because that's like instead of investing in those ETFs, now you are looking at investing in the direct indexing strategy. That gives you this power of tax loss harvesting. Or second, if you have, let's say, concentrated position in particular stock and you have a good capital gains associated with it and you want to kind of diversify out of it. So only in those cases it would make sense. Just the ETFs, just coming out of those to kind of get the tax loss harvesting by direct indexing isn't the best of the strategy kind of to implement.
Okay, so AJ asked, do my stocks still track the S&P 500? Is tax filing a pain?
No, tax filing is not a pain. It's very straightforward. You just get a 1099B from your broker based on the executions of the trade. You pass it on to, let's say, TurboTax or to your CPA. They should be able to process it immediately, and it's a very, very smooth process. And yes, to answer the first question, it does track the S&P 500. We have seen over the years the deviation from the actual return is plus minus 0.1 to 0.2%. So it's very, very close. Obviously, if you are kind of working with someone who knows how to do these things.
Yeah, and just further on that point, so the way that we've set up individual dashboards for clients that are utilizing this strategy, it's all tracked right there. So everything is in real time and you see it. And since taxes are all done right through the platform, it's very, very straightforward. Okay, the next is, do I have to sell my current index funds to start? Is that taxable?
Yeah, I mean, again, to answer that question, it's not the right approach to sell the index and then you get into the index via direct indexing. So I would say no.
Okay, the next one is how does Alfonso do direct indexing? What provider is used?
Yeah, so we partner with Charles Schwab to kind of manage all this direct indexing. So we have different strategies, let's say like international investing, domestic, US, large cap, small cap. So all these different strategies are there. And we work with Charles Schwab to set up your account and then run these algorithms that would manage in itself every aspect of from investing to execution and to, let's say, even the tax filing part.
Okay, so what would I typically pay for a direct indexing portfolio? Is it percentage of AUM or are there flat fees too?
Um, yes, that's a good question. And to answer that, I think almost everyone in this industry charges percentage AUM based on obviously the amount that you are kind of providing it to them. Obviously, with more the money that you give, the kind of more power you have to kind of negotiate the price. But it's very much like a percentage AUM. There are certain kind of financial advisors that may kind of charge you flat fee, but uh, it's very rare.
Yeah, and just to more on that, it is very rare. Typically, you're going to pay between 50 and 100 basis points. So 0.5% to 1%. So, if you're looking at a $500,000 portfolio, you're paying 5 grand a year to do that. Where, we're kind of the outlier here, where we are a flat fee subscription model. Okay, so how accurately can you track a custom index? What happens if you stray too much?
I mean, we don't generally because these are algorithms which are very, very well trained and very, very well defined and organized. So, I mean, as I mentioned, the deviation generally we are looking at is roughly 0.1%. So let's say, I mean, I can talk about last year's number, it was roughly 20.4%, and the direct indexing for S&P 500 was 20.3%. So it's 0.1% that we're looking at. And previous year, I remember it was 14.8 versus the return for via direct indexing was 14.9. So we are looking at roughly 0.1% of deviation.
Excellent. All right, so that's the last of the questions. All right, well, I didn't get swept away in the tornado, so that's good. We have a couple slots opened up next week to cover a little bit more on direct indexing. So when you get the email, book a time, and we'll dive a little deeper into it for you as an individual. Thanks everybody for joining us today, and we will see you in the next one.
Thank you.